Imagine owning a tiny piece of a giant company like Apple or Amazon. It's like having a small slice of a very large pie. This slice represents your share in the company's fortunes, both good and bad. That's what a stock is. A stock represents a fraction of ownership in a company. When you own a stock, you own a piece of that company, no matter how small. When you buy stock, you become a shareholder, a part owner of that company. This means you have a stake in the company's future and its potential profits. Companies sell stocks to raise money for growth. This process is known as issuing shares. By selling shares to the public, companies can gather the necessary funds to invest in new projects and innovations. This money helps them develop new products, expand into new markets, or hire more employees. Essentially, it fuels the company's growth and development, allowing it to reach new heights. As a shareholder, you participate in the company's success. When the company performs well, the value of your stock increases. This means your investment grows, and you can potentially earn significant returns. If the company does well, the value of your stock goes up and you make money. This can happen through an increase in the stock price or through dividends, which are a portion of the company's profits paid out to shareholders. On the other hand, if the company struggles, the stock value may decline and you could lose money. Investing in stocks carries risks, and it's important to be aware of the potential downsides as well as the upsides. Understanding stocks and how they work is crucial for anyone looking to invest. It's not just about buying and selling, it's about making informed decisions and being aware of the market dynamics. By educating yourself and staying informed, you can navigate the stock market more effectively and make choices that align with your financial goals. Remember, investing in stocks is a journey, and knowledge is your best tool. Why should you consider investing in stocks? Because they offer the potential for higher returns than traditional savings accounts or bonds. Over the long term, the stock market has historically grown at an average rate higher than inflation, meaning your money can buy more in the future. Investing in stocks is a way to build wealth, achieve your financial goals, and secure your financial future. Remember, investing in stocks involves risk, but it's a risk worth considering for its potential rewards. Ready to start investing? The first step is to open a brokerage account. A brokerage account is like a bank account for your investments. It's where you'll buy, sell, and hold your stocks. There are many brokerage firms to choose from, both online and traditional. Look for a brokerage firm that offers a user-friendly platform, low fees, and excellent customer support. Once you've opened your account and deposited funds, you're ready to start buying stocks. Before you rush into buying stocks, it's crucial to do your research. Don't just buy stocks based on rumors or tips from friends. Take the time to understand the companies you're considering investing in. What do they do? How profitable are they? What are their plans for the future? Read their financial statements, analyze their industry, and consider their competitive landscape. The more you know about a company, the better equipped you'll be to make informed investment decisions. Section 5. Factors to consider. Picking the right stocks for you. When evaluating stocks, certain key factors can help you make wise investment choices. It's essential to approach this process with a clear strategy and a thorough understanding of the market. First, consider the company's financial health. This involves delving into their financial statements and understanding their revenue streams. Look at their revenue growth, profitability, and debt levels. Consistent revenue growth indicates a company is expanding, while profitability shows it can manage its expenses effectively. Low debt levels suggest financial stability. Second, assess the quality of their management team. The leadership's vision and execution capabilities are crucial for the company's success. Are they experienced and capable of leading the company to success? Research their track record and see if they have successfully navigated the company through challenging times. Third, analyze the industry the company operates in. Understanding the broader market context can provide insights into potential growth opportunities and risks. Is it a growing industry with a bright future? Look for industries that are on the rise, driven by innovation, consumer demand, or regulatory changes. By carefully considering these factors, you can identify stocks that align with your investment goals and risk tolerance. Remember, investing in stocks is not just about picking companies that are performing well today, but those that have the potential to grow and succeed in the future. Take your time, do your research, and make informed decisions to build a robust and diversified portfolio. Section 6. Mistakes to avoid: navigating the stock market wisely. Investing in the stock market can be a rewarding endeavor, but it requires careful planning and a clear understanding of potential pitfalls. Investing in stocks comes with inherent risks, and it's easy to make mistakes, especially as a beginner. Many new investors dive in without fully understanding the complexities involved, leading to costly errors. One common mistake is investing based on emotions. When the market is volatile, it's natural to feel anxious or excited, but these emotions can cloud your judgment. Don't let fear or greed dictate your investment decisions. Instead, base your choices on thorough research and a well-thought-out strategy. Emotional decisions often lead to buying high and selling low, which can erode your investment returns. Another mistake is putting all your eggs in one basket. Concentrating your investments in a single stock or sector can be extremely risky. Diversify your portfolio by investing in a mix of stocks across different industries and sectors. This approach helps to spread risk and can provide more stable returns over time. Finally, avoid timing the market. Many investors try to predict the perfect moment to buy or sell, but this is a challenging and often futile endeavor. Trying to predict when the market will go up or down is extremely difficult, even for experienced investors. Market timing requires not only accurate predictions, but also impeccable timing, which is nearly impossible to achieve consistently. Instead, focus on investing consistently over the long term. Regular, disciplined investments, regardless of market conditions, can help you build wealth steadily. By staying the course and avoiding the temptation to make impulsive decisions, you can navigate the stock market more wisely and increase your chances of achieving your financial goals. Section 7. Patience is a virtue. Investing for the long term. Investing in stocks is a marathon, not a sprint. Don't expect to get rich quickly. The stock market can be volatile in the short term, but over the long term, it has consistently trended upwards. Be patient, stay disciplined, and don't panic sell when the market experiences downturns. Remember, time is your greatest ally in investing. The longer you stay invested, the more opportunity your money has to grow. Section 8. Diversification. Don't put all your eggs in one basket. Diversification is a key principle of investing. It means spreading your money across different investments to reduce your overall risk. Don't put all your money into a single stock or even a single industry. Instead, invest in a mix of stocks, bonds, and other asset classes. Diversification helps protect your portfolio from significant losses if one investment performs poorly. Section 9. Seeking advice. When to talk to a financial advisor. If you're feeling overwhelmed or unsure about investing in stocks, don't hesitate to seek professional advice from a financial advisor. A financial advisor can help you create a personalized investment plan, choose suitable investments, and answer any questions you may have. Look for a fee-only financial advisor who is a fiduciary, meaning they are legally obligated to act in your best interests. A financial advisor can provide valuable guidance and support throughout your investing journey. Section 10. Start small, dream big. Your journey to investing success. Investing in stocks can be a rewarding experience, allowing you to grow your wealth and achieve your financial goals. Start by educating yourself, opening a brokerage account, and investing a small amount that you're comfortable with. As you gain experience and confidence, you can gradually increase your investments. Remember, the most important step is to take action. Start your investing journey today and watch your money grow over time.